Good morning, everyone. This is the Crypto Minute with myself, Russell Shaw, Senior Market Specialist at FXCM. My email address is r@fxcm.com, and today is Wednesday. It's the 23rd of Feb 2022. I'm just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments, and then I will bring up the commentaries disclaimer, and then we'll get on with it. Okay, let's just bring up our market commentaries disclaimer here. Hey Anna, good morning. Nice to have you on the webinar as always. Thank you very much for joining, and thank you to everyone else for joining. And let's just bring up our references, Market Scope 2.0 and Trading View. All right, so Howard asking for Euro, US dollar, Aussie US dollar, and Japanese yen. I may do those later in the day, Howard. I want to keep this to crypto because I'm going to put it on the website. So what I'll do is I'll see if I can get some articles out for Euro, US dollar, Aussie, and the yen, and potentially put those on the Telegram. All right, let's start off with Ethereum, which is we don't usually start off, but it's just I wanted to start off here because Vitalik Buterin, who is one of the co-founders of Ethereum, did have an interview on Bloomberg, and he said that these he kind of embraced what he called the crypto winter. He embraced that because effectively what it came down to is it comes down to a shakeout. You know, whoever's left standing after the crypto winter potentially has the has the direction. Their processes, it's everything sort of streamlined and correct. So it's just interesting. That is what Vitalik Buterin did say on Bloomberg. If we have to just take a measurement of this year, we're about 45% down. Okay, which is a huge capital erosion from peak to sort of close where we are now. So we're about 45%. Yesterday it was about 47%. I'm just giving it benefit of the doubt because there's a bit of blue that's coming here, but there's a big capital erosion here. All right, so that's Ethereum. Now the other thing just to keep an eye on is trend. Of course, we want to keep an eye on trend. So there are two possibilities here that I see. Well, to be fair, there's actually three possibilities. The third one is the least appealing of them all, but let's just explore those. A peak, okay, peak, trough. Okay, so I think you guys can see where we're going here. Here's the lower peak, and that's all we've got. We've got three points as opposed to 4 points. I don't see. in the true, I guess the true, in very strict technical analysis, we can put this as a peak, this is a trough, this is a lower peak. Okay, we can put that, and then we do have a downtrend, and then we can put this as the LT, the lower trough. But and I guess that probably is the correct way to look at it, with a 45% capital erosion, but that's not going to help us now. Now it's all about trying to deduce future direction, which of course is never something that we can be certain of. But let's put in our lines 1, 2, 2, 3, okay, and now possibility 1. So I said there's 3 possibilities, the third one being the least appealing. So then we've got something like this, lower trough. Okay, so there's the I guess the trend. This would be the bearish scenario. That's situation 1, and situation 2 could be something like this. For the sort of crypto optimists, we would have trough, peak. Okay, now what we're looking for here, so now we've only got 2 points, okay, but what we're looking for here is the HT, the higher trough, okay. So this is now the second scenario. Trough, peak, higher trough, higher peak. Now we've got something that's looking a lot more bullish. So keep an eye scenario, the bullish scenario. What's the third? The third scenario is consolidation, congestion. So that would be for traders the least sort of I think favorable, the least beneficial of them all, at least in the short term. At least in the short term. So then we would have meandering of price kind of doing this. But I think in the long term, this may be beneficial in that if we get a break or half of it disappeared. So that's an indictment. If we go through to Bitcoin, let's just take a look at Bitcoin. And you can see that Bitcoin is in a similar situation here. Okay, so we've got how it's saying the sound's breaking up. Can you guys hear me? Can you guys hear me? Just let me know if it's actually moved. So kind of It's okay again. Okay. All right. I'll move to a better spot. It seems that my Wi-Fi has kind of hit a blind spot here. Okay. So here is 1, 2, 2, 3, 1, 2. So there's your first scenario. Okay. Here is your second scenario. Here's your second scenario. Okay. In other words, we would be looking for the higher trough here. And then the third scenario would be consolidation. Now, what I think is the big deal around cryptos, where I think the big deal around cryptos is when we start comparing it to gold, okay, because in my mind, it makes sense to do that type of analysis, and I'll explain that in a moment. But I'll add gold underneath here. I'm just going to add it to this list. I'm begging your pardon. Give me a moment. All right, so let's just add gold. So I just want it underneath. Okay, so this is where I think I think this is where it gets very interesting. Here is Bitcoin, okay, and here is gold. Very different trajectories. Now, why do I think it makes sense that we look at it in terms of this basic algebra? So if we go and just bring up Paint, okay, so we can go like this. So let's just say we had an algebraic problem dealing with fractions, right? So we had sort of a problem like this. So we go 2, okay, 2 over 4, okay, 2 over 4. All right, and let's just say that the math problem sort of was equals 1 over x. Okay, so basic sort of mathematic, however you want to solve it, but we would eventually arrive at a solution which would be 1 over 2. Okay, so 2 over 4 would equal 1 over 2. I mean, we can all see that. So that's sort of part 1. Okay, that's part 1. There is something else in terms of the forex market. How do you solve for strange crosses? So let's just say you had euro US dollar, okay, equal to 2 over 4. All right, as you can see, and let's just say you had and this is just sort of I'm thumb sucking figures here. So USD, okay, equals, okay, now watch this, x over y. All right, You understand now? The teacher says solve for GBP. Okay, so now we've got to think, well, wait a second, what's going on here? We've got only 2 out of 4 variables, and they're all, how do we solve? Well, y, we can substitute y in straight away. Y must be 4. Okay, y must be 4 because the US dollar here is 4. Okay, so once we substitute in, then we actually get, we can start solving for this. And in this equation, they're just going to equal, they're both going to equal 2/4. But the point is that once you've got a common, okay, once you've got a common variable, okay, you can start doing mathematical tricks, okay? Start doing mathematical tricks. So what's the big deal? Well, we've got here a situation where we've got in our top one Bitcoin is equal to the US dollar, okay? What do we have here? Well, we've got 1 troy ounce of gold, 1 troy ounce of gold equal to the US dollar, okay? Yeah, you see? So now we've got a common denominator. Now we can start saying, well, wait a second, US dollar must be the US dollar must be consistent. The denominator must be consistent between these two. US dollar can't be stronger on one chart and weaker on another chart. That makes 0 sense. US dollar has to be consistent. Okay, so if US dollar is consistent, then where's the discrepancy? Okay, well, the discrepancy must be on the numerator side. So Bitcoin is weaker, okay, than 1 troy ounce of gold. Does that make sense? Mathematically, does that make sense? Okay, because the numerator has to be consistent. It's equal to US dollars equal to X. US dollars equal to X. Does that make sense? So then the discrepancies have to be on the numerator side. Okay, so then the question is, well, why is there a discrepancy on the numerator side? Why is there a discrepancy on the numerator side? Well, there can only be one answer to that. Okay, demand versus supply. There is more demand for gold than there is for Bitcoin. If we agree that the US dollar has to be a consistent variable, okay, then the demand for gold is obviously stronger than the demand for Bitcoin. And the question then you've got, well, there's another question that comes from that. Well, why would that be the case? Why would market participants prefer to hold 1 troy ounce of gold relative to the dollar than they would be to hold 1 Bitcoin relative to the US dollar? Well, again, then there's only one reason for that, and that would be because gold is viewed as having more value than the Bitcoin. Okay, so immediately we can see that the demand-supply equation is against Bitcoin. It would be against Ethereum too. It would be against cryptos relative to any other ratios where the US dollar is the denominator. Does that make sense? Are you guys with me? I'm not getting any. Can you guys hear me? I'm not sure that the volume can you guys hear me? Just give me a Y or an N. Okay, cool. All right, cool. All right, cool. So the trajectory of gold versus the trajectory of Bitcoin is problematic. It's problematic. If you're a Bitcoin bull, okay, the fact that it is moving down relative to a consistent denominator must concern you. You've got to ask the question, why is this the case? Why is this the case? We're at a time now where there is geopolitics that could play into it. Okay, that could be the gold has historically been the safe haven. The prospect of a conflict, over Ukraine, Russia border, and just the real dangers associated with that, could be a very obvious reason. It seems to be a very obvious reason why money is being pushed into gold, okay, because it's a safe haven. Well, if that's the case, well, then clearly Bitcoin cannot be a safe haven because money is leaving Bitcoin. Okay, it's going into the US dollar. Okay, in other words, the market sees the US dollar safer relative to Bitcoin. Okay, because as the geopolitical situation, as the tensions heighten, money's been moved out of Bitcoin into the US dollar, but at the same time, okay, it's been moved out of the US dollar into gold. That says a lot. Okay, there's a certain sort of causality there. There's a certain cause and effect. So we've got to keep our eye on this. The idea here is that the geopolitical situation certainly seems to suggest gold is a safe haven and Bitcoin is not a safe haven. That's fine. Okay. Let's now assume that gold. Let's now assume that gold is a. Let's now assume, I beg your pardon, that the geopolitical situation, hopefully there's a diplomatic solution and sort of quietens down, and we start now focusing on the underlying macroeconomics, which is generally inflation. That's the macroeconomic that everyone is looking at. And by the way, the need for a diplomatic solution here, just in terms of an economic sense, is huge because oil is skyrocketing towards $100. So if oil's skyrocketing towards $100, okay, you've got a situation like this. Okay, then you've got a situation like this. Okay, so we're going to call this inflation. We'll just call the y-axis inflation. We're going to call this a GDP. Okay, so a country's gross domestic product, and every country has its own what we call potential. So that's kind of where your full employment level is. This is long-term supply. But that's every country has a true macroeconomic equilibrium is where your aggregate demand and your aggregate supply intersect with potential. That's kind of your Goldilocks type of scenario. But what we know is, so just look at this from the demand side. What we know is that inflation is problematic. And the reason inflation is problematic is because the demand curve is actually shifting outwards. You can say it's been shifting out because of loose monetary policy. You can say it's been shifting out because of loose fiscal policy. But you can see the retail sales last 2 weeks ago were blowout numbers. So there's huge consumption. So the aggregate demand curve has been shifting out, and that's fine to a degree, to a point, because you can control aggregate demand with interest rates by tightening. What happens now with oil jumping? Okay, now let's put in an aggregate supply. Okay, so your equilibrium here would be at the intersections. In this example, we less than potential, which is, but we are kind of moving closer. This over here is your, what we call an output gap. And you can see as the recovery has taken place, the output gap is narrowing. But what's the byproduct? What's the negative effect of the output gap narrowing? We're getting a ridiculous amount of inflation here. Okay, so where we started at our inflation level, let's just call it inflation level 1. Okay, we're now at inflation level 2. Now, what you can generally do, okay, and this is what central banks are doing, is they can start taking liquidity out of the market, and what that does is it actually starts shifting aggregate demand down. Okay, so kind of they start playing around with this. A policymaker's nightmare is now the fact when your supply side inputs start increasing. In this case, the price of oil. Okay, so now your price of oil has increased. Well, that causes the supply curve to shift to the left. It must shift to the left because producers are paying more for oil, so they'll have to cut down either on production or costs to, because their margins are starting to get squeezed, right? So, but now look at what's happening here. Is you've got so now you've got a movement to 3. Okay, we'll call this one 1.5. So with this increase in energy prices, which is because of geopolitics in an already tight market, you've got a movement where you've got this all of a sudden this fear of, guess what this is called? This is called stagflation. Okay, this is where prices have increased. Okay, prices have increased, but your GDP is decreasing as well. All the other times you have price increases where your GDP was actually increasing. That's not stagflation. As soon as you start getting input prices moving, we're up 20% in about a month. Okay, in about a month and a half. That's huge. Now you've got the real prospect of higher prices with lower GDP. That's scaring the policymakers like you cannot believe. Okay, and because that is the case, okay, money is being pushed into gold. Okay, because gold is a safe haven. Okay, Bitcoin's not. Okay, so the idea here is, so there's a comment, but wait a second, gold's been moving since November. Yes, gold has actually been moving since before November. It's been moving since here. Okay. So is Bitcoin. Okay, so on an absolute basis, since March, there's been a huge outperformance by gold over Bitcoin. Huge. And it's just saying against. So what we'd have to do, we'd have to kind of, I wonder if we can do it this way. Theoretically, we should be able to. Let me just see. All right, let's just bring this up here. I'm not sure if this is going to work, Anna. Just giving you a heads up. I'm going to do relative strength. Theoretically, it should work. So if I just go Bitcoin, USD. I'm going to just use the Trading View Index. Okay, I just want to change this to logarithmic. And then what we could do here is I could just thinking what's the way to do this, Anna. I think this would work. I just want to FXCM This should work. I just got to think about it mathematically. I'm not sure if it works. Let me just bring up my, just want to do some math. So it would be Bitcoin over USD divided by divided by gold over USD. I don't think it's quite right. Bitcoin USD then would be times USD over gold. Yeah, it actually, I think it is right. If that's the case, then the denominator and the numerator should cancel, giving us Bitcoin over US dollar. Okay, I think it's right. Okay, so I think this is Anna's saying there is a XAU BTC chart. Okay, let's see if I can bring that up. Calculated by TradingView. Let's do it this way. Let's do it this way. Let's just do it 1 over, and then we can kind of, yeah. All right. Yeah. So it's kind of exactly. It's kind of the same thing, isn't it? So yeah. All right. But the idea here is, of course, that Bitcoin would be, on an absolute basis, seriously underperforming gold, because Bitcoin's the numerator, gold's the denominator. So there's the, on an absolute basis, with volatility in between. So we'd call this volatility over here. So but if you had to draw just an absolute line, clearly the Bitcoin is the loser here. So that's the so now we want to just see if there is a calming on the geopolitical front, if that means that money is starting to move out of safe havens back into a into sort of your more risk type of investments. Does that benefit Bitcoin? Because it seems to me that the conclusion here is Bitcoin cannot be a safe haven, because we are in a geopolitical situation where safe havens are in demand. Bitcoin's not in demand. So we want to now keep an eye on this post the geopolitical situation and start the analysis from that point. All right. Any questions? Please go ahead and type those through. Any questions? Please go ahead and type those through. All right. Let's conclude at this point. I'll put both of these up on Insights. I'll try to do some articles on those currency pairs, and I'll put those into TradingView. I'll put these videos on Telegram as well, I beg your pardon. All right, guys. Thank you very much for joining, and please join me this afternoon for the scalp. Thanks, guys.